Central banks, they kind of hold the keys to our economic lives. They've got these powerful tools to try and keep everything on the rails. But what happens when those trusted tools just stop working? Today, we're going to dive into the really dramatic evolution of the central banker's toolkit, from the reliable old classics to the radical weapons that were forged in the heat of a crisis. It's a huge question, isn't it? I mean, think about it. Billions of people, trillions of dollars, all moving at once. Well, that's pretty much the job of a central banker, to try and steer that massive ship. But to do that, you've got to know where you're trying to go in the first place. So before we can even get into the tools themselves, we have to understand the mission. What's the ultimate goal of all this economic engineering? What are they actually trying to achieve? And it all comes down to this term right here, monetary policy. This is the official game plan. And the core objectives are almost always the same, no matter where you are in the world. You want to keep people employed, and you want to keep prices stable. It's an incredibly delicate balancing act. And that mission can look a little different depending on the central bank. Here in the US, the Federal Reserve has what's called a dual mandate. It has to juggle both jobs and prices, giving them equal weight. The European Central Bank, on the other hand, has one main focus: price stability. They aim for a symmetric 2% inflation target, and that word symmetric is key. It means they're just as worried about inflation being too low as they are about it being too high. All right, so for decades, central bankers had this reliable, old-school set of tools they could always count on. Let's call it the conventional toolkit, the original Swiss Army knife of monetary policy. And here they are, the big three. For most of the 20th century, these three pillars were the absolute bedrock of central banking. They were seen as simple, they were seen as effective, and for a very long time, they were pretty much all that was needed. So how did this stuff actually work? Well, the main workhorse was always open market operations, or OMOs. The process is pretty straightforward. The central bank buys bonds from commercial banks, and that injects fresh cash right into the banking system. More cash means banks have more to lend, which encourages borrowing and pushes interest rates down. And if they want to tighten things up, you guessed it, they just do the whole thing in reverse. Next up, you have reserve requirements. This is just the rule about how much cash banks have to physically keep on hand in the vault. This used to be a really big deal, a major lever they could pull. But in March of 2020, the US Fed cut the requirement all the way down to zero. So, yeah, a once powerful tool has basically been put on the shelf to collect dust. And finally, there's the discount rate. The best way to think about this is as the emergency backstop for the whole system. It's the rate banks pay if they need to get a short-term loan directly from the central bank itself. Its main job is to be that lender of last resort, making sure the financial system doesn't completely seize up during a panic. For decades, this toolkit worked just fine. It was predictable, it was reliable. But then 2008 happened, and the global economy was hit by a tidal wave that would completely break the conventional machinery of monetary policy. Just look at the speed of this collapse. It's breathtaking. In just over a year, the Federal Reserve slammed its foot on the accelerator, cutting its main interest rate from over 5% all the way down to basically zero. They had completely run out of road. And this is the trap they fell into. It's called the zero lower bound. You can't cut interest rates below zero, or at least that's what everyone thought at the time. The conventional toolkit was officially exhausted, but the economy was still in an absolute freefall. So what do you do when your trusted tools are broken and the house is on fire? Well, you head to the workshop and you start inventing some new ones. This was the dawn of unconventional monetary policy. And you have to understand, this shift was fundamental. Policy moved from using those standard OMOs to just fine-tune short-term rates to something way more powerful: quantitative easing. This was a tool designed for pure economic stimulus when you're already stuck at zero. So what in the world is QE? Well, instead of just nudging short-term rates, the central bank starts buying massive amounts of long-term assets, like government bonds. And in doing so, it injects a tidal wave of money directly into the financial system on a scale nobody had ever seen before. And let's be clear, QE is not just a bigger version of the old tool. It is a totally different animal. The scale is massive. It targets long-term interest rates, trying to bring down the cost of things like mortgages and business loans. It can even involve buying private assets. The goal isn't just to manage a single rate anymore. It's to jolt the entire economy back to life. What started as this desperate experiment during the 2008 crisis quickly became standard operating procedure.
So, when the COVID-19 pandemic hit, central banks didn't hesitate for a second. They just opened up the unconventional playbook and went to work.
And the sheer scale of the COVID response was just staggering. I mean, look at this chart. In just 1 month, April 2020, the Federal Reserve bought more assets than it did during the entire global financial crisis. The emergency tools had officially become the main event. But with all this new power comes a huge amount of risk. See, these massive actions take a really long time to actually ripple through the economy. There's a delay, and it's known as a policy lag. This means central bankers are essentially flying a jumbo jet in the fog. They're forced to make these huge decisions before they can even see the effects of their last move. And this reveals a really critical lesson here. Monetary policy can't do it all. During the 2008 crisis, for instance, government spending and support, that's called fiscal stimulus, it basically dried up, leaving the Fed to fight that massive economic fire all by itself. The result was a much slower, more painful recovery, which really proved that these tools work best when they're coordinated with government policy. So that leaves us with this final critical question. The unconventional has now become completely conventional. The emergency break glass in case of fire measures are now just part of the standard toolkit, which begs the question, what ammunition do central banks really have left for the next major crisis?